Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers, and today's video is going to be hosted by our friend Jack with Nobody Special Finance. Jack, how are you, sir?
I am fantastic. It's such a pleasure to be back, Travis. Thank you for having me on.
Yes, sir. And what are we going to be talking about today?
Today, we are going to be talking about the labor market. One of my favorite topics, the strong jobs market, air quotes. Hint, it's not really that strong. But it's actually, It's not on fire either. So we're going to do a deep dive into some of the data. We got some new data points in the last couple of weeks. We got some new stories that are in the press. We're going to get a total view of what's going on in the job market, because as you've been saying on your channel, the job market is the key to the supply of homes in the real estate market. So you got to understand what's happening with employment.
And I'm sure you're going to be talking about the massive quantities of revisions, I hope.
We will address the revisions that all tend to be in a certain direction. It's purely coincidental, I'm sure. Nothing nefarious at play there.
Now, before we begin, guys, go over to Nobody Special Finance. Here's his YouTube page right here. I absolutely love it. He also does morning lives. I believe market open every single morning. Is it at, what time is that at, Jack?
At 9 a.m. Eastern time every day. I do a live stream about a half hour ahead of market opens. We just talk about the biggest stories of the day, and we do that every weekday.
I love it, man. I'm a huge fan. So, let's start, Jack, by let me give you control of the screen. You just go ahead and take away, man. Take it away. Let our viewers know what's going on in the job market. What should we be worried about? How does it help us as consumers? The mic is yours, sir.
All right. So the first things first, we are looking right now at the non-farm payrolls report. This came out at the beginning of the month on September 1st. This was released for the August data. And we had the U.S. economy added 187,000 jobs in August. Now, that was very slightly more than were expected, but that is down substantially from some of the 350,000 numbers that we were getting early in the year. Now, the economy is adding jobs, but you're going to see in some of the data, it's not necessarily all a good thing, because we're adding the wrong jobs. We're losing the good jobs. We're gaining some of the not so good jobs. We've got people taking second jobs. But also keep in mind that we need to add a little over 100,000 jobs virtually every single month just to keep pace with population growth. So 187,000 jobs added is not nearly as good a data point as it sounds like. Now, the first thing I just want to talk about here, total non-farm payrolls increased by 187,000 in August. And also importantly is that the unemployment rate ticked up. It was 3.5% and it jumped up to 3.8% last month. So we've been kind of in this low threes range all year. This was the first significant uptick we've seen in unemployment in a long time. So that kind of caught people off guard. It's nowhere near trouble territory yet. Also, within a few sectors, we had unemployment continued to trend up in healthcare, leisure and hospitality, social assistance, and construction. Those are the areas that are doing pretty well. Employment in transportation and warehousing declined. And that's important because transportation and warehousing, that is the movement of stuff. And if transport and warehousing, the people who move the stuff, are not doing well, then it's only a matter of time before the people who make the stuff are not doing well and the people who sell the stuff are not doing well. So that, to me, is forecasting trouble ahead for retail, for consumer spending, for the economy as a whole. The unemployment rate rose, as I mentioned, by 0.3 percentage points to 3.8% in August. That's a pretty significant number. And I thought this one was pretty interesting because although all the attention goes to the 187,000 jobs added in August, and then the politicians congratulate themselves on their economic plan working and all that fun stuff, yada, yada, yay me. But this data point was important because the number of unemployed persons increased by 514,000 in the last month. That's pretty substantial. 500,000 people, 500,000 more people are out of work, even though jobs were created. So that's a pretty alarming statistic right there. More than a few months of those kind of numbers, and we're going to be into trouble in the housing market territory. Now, you mentioned the revisions earlier. That's another important one because like every other month this year, when the jobs number came out, there was a downward revision to the prior month. And even though we added 187,000 jobs in August, the July jobs number was revised lower by 30,000. So you can subtract 30,000 from that 187,000 gain. Now we're down to just 157,000 jobs added. Not at all a good number. And you can see here what this chart is showing you. These are some of the prior months from this year. You're seeing January, February, all the way through to August. The blue number is the initially released number. And the politicians congratulate themselves and they make their stupid speeches. Yay me. And then what is that? Brown, I guess. Brown or yellow. I'm partially colorblind. But this next number, that's what it gets revised to later on. And you can see every month this year, the number has been revised downward. And then the red bars here in the negative territory, that is the size of the downward revision. And you can see every single month this year, without fail, the jobs number has been revised lower for a total of about 270,000 downward revisions after the fact. So they overstate the number, make themselves look great, and then they very quietly revise it in the following months.
I would say that color is lumber. Let's call it lumber.
Lumber color. Okay. That's good. All right. So moving on here, another thing we talked about the last time I came on and we talked about the job market. We talked a lot about full-time versus part-time, about multiple job holders. Now, if you're ever curious and you want to go look in these non-farm payrolls reports, you'll find this stuff in table A9. And that's where the real juicy stuff in the jobs report is found. And I just want to scroll down here to full or part-time status. Again, this is in table A9. Now, all the way over here, these numbers, this is the number from July, and this is the number for August for full-time workers.
Is that thousands of units?
That's in thousands, correct. So if you see 134,274, that's 134.2 million or 134.3 million is what we're talking about there. So for the month of August, we actually lost 85,000 full-time jobs. That's people who were working full-time. Now they're not working full-time. Now that's bad. We're losing full-time jobs, which comes with benefits, comes with good pay. But consider the prior month from June to July, we lost 585,000 jobs, full-time jobs. So we're still trending in the wrong direction, but not nearly as badly as we were a month ago. That June to July revision of 585,000 full-time jobs lost, that was substantial. Again, it gets no press coverage, but we're still trending in that direction. We lost another 85,000 full-time jobs, and we're seeing this trend over and over again. We're losing full-time jobs. We're gaining part-time jobs. So, I used to be a software engineer. I used to be a banker. Now I'm a barista at Starbucks, or now I'm a greeter at Walmart. This is not economic prosperity. This is people's lives getting harder.
I was looking at the numbers under the full-time workers, and it looks like, and I'm not 100% sure, but all the way to the left, that looks like January to February. Is that correct?
These first few numbers here, these are the non-seasonal adjusted numbers.
Oh, okay. I gotcha.
So, let's talk about that for a minute. The seasonal adjustment, as I call it, is the fudge factor. These are the seasonally adjusted and these are the non-seasonally adjusted. Every year, you typically have layoffs during certain months, or you gain part-time work during the summertime as people get summer jobs. There's certain industries tend to hire every year. So the seasonal adjustment is what I've been going off of. Now, that's not a perfect indicator, though, because one of the ways that you can mask or you can hide bad trends in the economy is by messing with the seasonal adjustment factor. That has been going on also, not quite as bad as the revisions things, but for the most part, if you really want to do an apples to apples comparison, you have to go with the seasonally adjusted numbers, recognizing though that is not a perfect data point, because you can just change the way you seasonally adjust and make the numbers say whatever you want. Now, part-time, we're getting kind of something similar to what we had under full-time. Now, under part-time jobs, we had in July, 27.1 million people were working part-time jobs, 27.15, I should say. And now we have 27.18 million people working part-time. Wow. So we lost 85,000 full-time jobs in August, but we gained 32,000 part-time jobs in August. So again, you lose the job as the programmer, you get the job as the barista. This is not good for the economy. And also, this is a continuation of a prior trend, but to a lesser degree. If you recall, in the June-July timeframe, we had a massive jump in part-time numbers, again, seasonally adjusted. But from June to July, we gained 972,000, and that's already accounting for summer jobs. So there's a lot of part-time
Wow.
jobs being gained, but now it's not nearly as much. Now we're only gaining 32,000 from July to August. So we still have that trend of gaining part-time, losing full-time. Now, another interesting thing that happened in the last month was this multiple job holders category. Again, we're going to go over here. Now, we had a big jump from June to July in multiple job holders. From June to July,
Yeah.
we had 118,000 people got second jobs. And that was a pretty scary trend. That's people missing little league games, right? That's lives getting ruined because dad has to get a second job or mom has to work a night job. We saw a little bit of a correction in that for the August numbers. We actually lost 85,000 multiple job holders in the month of August. We went from 8.11 million to 8.02 million. Now, coincidentally, that loss of 85,000 multiple job holders in August, that perfectly coincides with the loss of 85,000 full-time positions. So it kind of looks like not that people are opting to not work second jobs, but maybe that guy who took a second job a month ago just lost his full-time job. So now he's left with just his part-time work that he took on the side. Wow. Again, these are not good signs for the economy. Not yet alarming numbers, but certainly not a good indicator. We talked about the unemployment rate. It rose from 3.5 to 3.4. Now, these bars here, each bar represents a month going back to about September of last year. The important thing to recognize here is we've been in this 3.4 to 3.7 range. We've been bouncing around for the better part of the last year. We finally broke out to the upside. So if last month is any indicator, it looks like we're finally out of this no man's land we've been in as far as the unemployment rate, and now it's starting to rise. This is the lag effect of the Fed's rate hikes starting to affect the job market. And so we're probably going to see this trend continue for a few months. However, when you zoom out, let's zoom out to a 5-year chart. You can see here we are right now. We're still very, very low historically speaking. And, you know, this massive spike in unemployment after the pandemic just messes up the whole chart for everybody. So you can't really draw many conclusions from this. But I just wanted to point out that unemployment's still very low. Something else that we just broke out of a band that we've been stuck in is the labor force participation rate. This is the number of people who are of working age who are at either working or trying to work, right? If you're unemployed but you're trying to find a job, you are counted in the labor force participation rate. If you're unemployed but you're not even trying to find a job, you just gave up looking, then you don't count in the participation rate. So we also got a pretty big spike in the participation rate from 62.6 to 62.8%. So I interpret this as financial hardship pulling people back into the job market. Either that guy who quit his job because he was on the couch and he was just living off of stimmies in 2021, he finally ran out of money. Now he's got to go get a job. Or another thing that this could be is this could be people on fixed incomes like retirees, people being unretired by the rising cost of living. And so grandma had to go get a part-time job because her Social Security and her pension no longer makes ends meet for her. So people are being pulled back into the job market by financial hardship. And you see, we spent 5 months at 62.6%. We finally broke out to the upside.
Yeah.
Now, again, when in doubt, zoom out. So you zoom out on a 5-year chart, you can see, okay, we had a big drop in participation rate with the pandemic. A lot of moms decided the kids are going to be home. Now I'm going to try to be a stay-at-home mom, or maybe stay-at-home dads became more of a thing during the pandemic. Now, as the stimmies have stopped flowing and as the interest rates and inflation have made life more expensive, people have been creeping back into the job market. Now we finally took a substantial step up here, but you'll notice we're still below pre-pandemic levels on the labor force participation rate. So a lot of people left the job market, have still not returned. And if you just zoom way out, like to a 25-year chart, you can see we've actually been in a very long-term declining trend of people leaving the labor market and not coming back.
Wow.
Now we're starting to correct that back upward, but still a long way to go to get anywhere near where we were before the GFC or before the dot-com bubble.
Amazing.
Something else I want to point out, average hourly earnings. This just came out. That rose 4.3% year over year. Now, these numbers that you're looking at, these fives, fours, these are the year over year change in average hourly earnings. So this latest number, we're comparing what you made in August of 23 versus what you made in August of 22.
Mm-hmm.
When it's the July numbers, July of 23 versus July of 22. Now, this is important because this is for tracking real wages. These numbers are not adjusted for inflation. So even though back here in September, when we saw 5.1% wage gains, keep in mind back in September, inflation was closer to 9%. So yeah, your wages went up 5%, but the cost of living went up 9%. So you saw a 4% reduction in your standard of living.
I mean, that's if you made income increase, Jack. My income didn't go up. I made less money this July and August than I did last year. So I don't fall into this, actually.
So you get the benefit of making less money and your cost of living went up.
Lucky me.
Yeah, lucky you. Congratulations for that. Good luck with that one, Travis.
I could use that right now, so I appreciate it.
By the way, I left my day job to do YouTube full time, so I am definitely in the substantially negative real wage category here.
We aren't in these numbers, man.
But one thing I would point out is inflation has come way, way down since September of last year. So even though wage gains right now are 4.3%, it's the lowest this chart has been. Inflation is only at 3.3% right now, according to CPI, the Consumer Price Index. We get another data point tomorrow morning, actually, but I'm not sure when this is going to air. But for the last 2 months, those are the first times in a long time that we've actually seen positive real wage gains. For the month of July and August, our wages actually rose faster than the rate of inflation. Now, it was a paltry amount, like you're talking not even a full percent. And so nobody's noticing, especially in the context of the massive increase in standard of living or in the cost of living that we saw last year. But the trend is finally in our favor. But don't worry, the Federal Reserve is going to ruin that for all of us. Moving on, we've got average weekly hours. This is another chart that's a little alarming because they cut back your hours before they lay people off. That's a pattern with employers. We did see a very slight uptick in average weekly hours last month. We went from 34.3 to 34.4. But I'm starting to notice here we've got a pattern of lower lows and lower highs. So the average hourly hours is in decline. Again, if you zoom out here on a 5-year chart, you can see average weekly hours have been in decline steadily for about a year and a half now. And that chart is continuing lower.
I also break this trend, Jack. I can't even fathom how someone would only work 34 hours a week. I think I worked 34 hours the last 3 days.
Yeah. I've been, especially over here, I've been doing that in two or 3 days lately too. But this is the average across the whole economy. And I think this also, I'm not sure if this accounts for sick time and vacation time also. It could, but suffice it to say, a 34-hour week, we should be so lucky. I can't remember the last time I worked 34 hours in a week. It was a long time ago.
Yeah.
Something else I want to talk about, initial jobless claims. Now, these are weekly snapshots, no longer monthly numbers. Every bar here represents a week. Initial jobless claims are still very low. The number of people losing their jobs and going on unemployment every week is pretty low. And we only had 216,000. So again, this chart doesn't really suggest that there's any alarming trends of job losses in the labor market. We had this big spike up here. That was a couple of weeks ago by about 30,000. That was the yellow trucking bankruptcy. We had 30,000 people lost their jobs when yellow trucking went out of work. And ever since then, the number of initial jobless claims has started to trend down. So yeah, there's stories about layoffs are starting to accumulate again in the economy, but it's really not that alarming of a trend. We get the same thing in continuing jobless claims. Now, these are people who have been collecting unemployment for, I believe it's 2 weeks or more. And continuing jobless claims also trending down, also still pretty low. This means that even if people lose their jobs, they're not staying unemployed very long. People are still able to find new work if they lose their jobs. It doesn't say anything about the quality of the work, right? We're losing full-time, we're gaining part-time, but there is work for people who are looking for it right now, assuming their standards aren't too high. Now, along the lines of these weekly snapshots in the labor market that, the initial and the continuing jobless claims aren't bad, we are starting to see a pickup in the anecdotes, in the stories about layoffs. Remember in January, the tech layoffs were all the rage. And then we had the layoffs in the banking sector in March. And then for a couple of months after the Fed injected liquidity, we really didn't see the stories of the layoffs. We took a break on the layoff stories, but that is now starting to come back. Right as interest rates have risen again, where the 10-year yield is back higher than it was in March now. Now we're starting to see a couple of stories like this that I want to talk about.
Wow.
We've got U.S. Bank Truist plans sizable job cuts to save $300 million in costs. All right, this one just hit the tape yesterday. Truist is talking about, they didn't give any numbers here, but they're talking about cutting enough jobs to save $300 million in costs over the next year. So
wow.
This is interesting because this is probably going to result, there's probably only a few hundred layoffs at Truist. But I want to put this in the context because that name, U.S. Bank Truist, is important because it was just a few weeks ago on August 9th that we had this story. Moody's cuts ratings of 10 U.S. banks and puts some big names on downgrade watch. One of the banks that was put on downgrade watch was Truist Financial. So it was just a few weeks ago that Moody's came out, they downgraded a bunch of banks, and they issued a warning about potential future downgrades of some others. And now a month later, one of those names is cutting a substantial number of heads from their payrolls. So this is forecasting trouble among small regional banks in the future. And, keep an eye on that one because March wasn't that long ago, guys. The second, third, and fourth largest bank failures in U.S. history are only a few months ago. And a lot of people were very quick to declare that crisis over. Not so sure that's the case. We've also seen some other cases like this one, Zebra Technologies to cut 700 jobs. Again, not a huge number. It's a few hundred jobs here, right? In the context of the economy adding 187,000 jobs last month, this seems like a drop in the bucket. But for everyone you see a story about, there's probably 100 that don't get coverage in the press. And Zebra Technologies is interesting because these guys do inventory management technology. These guys make software for inventory management. They make barcode scanners. All right. And remember, one of the areas of weakness was in transportation and warehousing. We saw the yellow trucking bankruptcy. 30,000 people lost their jobs. Well, these guys sell the tech that the guys in the warehouses use to manage inventory. So if their sales are down and they're laying people off, that means the warehouses don't need to manage as much inventory. That means consumer spending. That means trade is slowing. So this one stuck out at me as a pretty significant story. Even though it's only a few hundred jobs, you got to look at what sector they're in and what they do. And when you view that in the context of, okay, other people in transport and warehousing are also having trouble, this is a big deal. And we also got this last one here. Roku stock jumps after the company says it'll lay off 10% of the workforce. Roku, not really a barometer for the health of the whole economy or anything, but they're cutting 10% of their workforce. That's a significant portion. It's only a few hundred people. Again, not a big deal. But one thing I want to mention here, I want to really zoom in here, is Roku stock jumps after company says they're going to lay off workforce. The stock market is rewarding companies that cut jobs, which means more companies are going to be incentivized to do that because company executives, their compensation is determined by stock performance. So the stock market is still happy when they see job cuts, and the companies that cut jobs, their stock does well. And that just tells me we're going to get more layoffs in more publicly traded companies. And that is what I got for you today, brother. So what I like to do at the end of all my videos, I like to say long story short, right? So long story short, the job market is not nearly as strong as they tell us it is. All right. Adding 187,000 jobs plus the downward revisions, that's not enough to keep the unemployment rate where it is. The unemployment rate is rising, but it's not that high yet. So yes, there's weakness in the job market, and the job market is getting weaker, but we've got a long way to go. There needs to be a lot of layoffs, a lot of big rises in unemployment before the unemployment situation gets so bad that it might have an impact on the housing market. And the other thing you need to keep in mind is that when somebody loses their job, they don't lose their house right away, right? Yeah. Your house doesn't get foreclosed on just because you lost your job. You have to miss a few payments. and then they start foreclosure proceedings. And foreclosure proceedings usually take a few months to play out in court also, assuming people don't just sell their house to get out ahead of it. So I think the takeaway here is, although there's weakness in the job market, we're still probably several months away from seeing any serious impact in the housing market as a result of this.
A couple questions, man. You may not, have your crystal ball in front of you. If you don't, please go get it. But my first question, sir, to you is do you think unemployment will become unhinged? And by unhinged, let's just put a number. Let's just say it goes over 6%.
For that, give me 1 second. I'm going to bring that unemployment chart back up because I'm going to show you something that I've noticed in that. So looking at the unemployment rate here, as they say, the unemployment rate takes the elevator up and the stairs down. And the thing about unemployment is it rises. When it rises, it tends to rise very rapidly, very suddenly. Take a look. This is going all the way back to 1950. Maybe I can zoom in a little bit here and get you a better read on this. All right, going all the way back to 1950, you can tell here that the rises in unemployment, they happen very suddenly with the onset of a recession. And then it takes years to recover. They come down slowly, and then they spike right back up. They spike up quickly, and then they grind lower. And then, obviously the pandemic, that was something of an outlier, but you can even see here at the GFC, right? Unemployment, it ticked up for a couple of months at a little bit of a slow rate. And then all of a sudden, 2008 just slammed straight up. It went. So unemployment, if you zoom in right here at these most recent few months, it looks like it's put in a bottom and it's creeping up. We're still a ways off, and there's really no crystal ball here to say, okay, it's going to happen on this day, and then we're going to get that catastrophic rise in unemployment. But I would point you to that story about Truist Bank, because big spikes in unemployment, they tend to coincide with some kind of black swan credit event, some type of financial crisis, when the banks all go on defense and they stop lending at all the same time because one of their cousins failed. That tends to be what triggers the sudden spike in unemployment. So I don't think that sudden spike in unemployment is necessarily right around the corner next week or even next month. But we're already seeing the early indicators, stress in the banking system, banks tightening their credit standards. Defaults are starting to rise in credit cards and in auto loans. So it happens so quickly and so suddenly, there's no way to say when it's going to happen. Just know that when it does happen, it's going to happen all at once.
So just to recap on the question, do you think it's going to hit 6%? Maybe not tomorrow, but do you think before we're done with the Fed message? Well, actually, when are they ever going to stop? But do you think that it eventually does hit 6%, or do you think we hit a soft landing?
A soft landing, no chance. No chance. 0.0% chance of a soft landing, in my opinion. I would be very surprised if unemployment doesn't hit 10% this time around. I really would.
So you'd be surprised if it doesn't hit double digits?
Correct.
Okay. Next question. I know this is a hard one, but you're the right man, I think. And I've thought about this myself, Jack, and I've asked myself, why do I think this? If you were to guesstimate, when do you think unemployment can get worse? When do you think it's going to hit the worst?
When would the worst unemployment be? That's another one that's hard to guess. Just looking back at some of the prior crises, right? You get that big surge in those first few months after the credit event. Looking here, when did unemployment actually peak? It looks like it peaked in just before 2010. So late 2009 in the GFC is when unemployment hit its peak. Even though the GFC started late 2007, it didn't really become a crisis in the mainstream until 2008. So when the line goes vertical, you're still looking at probably, I would say, 6 months to a year and a half of significant increases in unemployment before it stops. So I don't think that this is going to be something that, okay, we got a 1 month spike in unemployment.
Yeah.
Fed go burr, everything's fine. I don't think it plays out that way, especially now that Jerome Powell appears committed to fighting inflation and the higher for longer narrative. I don't think Fed go burr. I don't think we go back to zero interest rate policy, or I usually call it Zerpenburr. I don't think we get a return to Zerpenburr until people are crying out for it in the street. You know, I've been saying on my channel for a while, they'll turn the money printers on, but only because we beg them to. And you talk to the average person on the street, you talk to the average business owner right now, their biggest concern is still inflation. So we need to do a full 180 with what people are worried about before we even get to a situation where the Fed is even going to be thinking about lowering rates. And usually unemployment doesn't peak until several months after the Fed lowers rates back down to almost zero. So I think we've got a long way ahead of us here before we get anywhere near that.
In what play, if any, Jack, do you believe that the commercial loan refinance crisis, so commercial loan, office buildings, strip malls, those loans are due. They're in favorable financing. They're not 30-year fixed rate mortgages. A lot of that is adjusting. And actually, the highest amount of that adjustment, it's not even this year. It's not even next year. It gets worse in 2025. What effect do you think that forced forced financing from lower rates to higher rates, what impact do you think that's going to have on unemployment?
So the most concern I have with commercial real estate, and that is a substantial problem, by the way, arguably the biggest problem facing the economy right now, arguably, I'm not saying it definitely is, we have about $1.5 trillion of commercial real estate debt maturing in the next year and a half. And most of that right now, as the debt matures, most of the borrowers are handing the keys to the building back to the lenders and walking away, which means the lender is eating the loss.
Yeah.
And most of the lenders are America's small banks.
Yep.
And America's small banks are in bad shape right now. So commercial real estate could be the trigger for that black swan credit event where all the banks go on defense and stop lending that I talked about. That may be the straw that breaks that camel's back. Now, right now, there's this, they call it extend and pretend, where some cases borrowers are having success negotiating with the lenders because the lenders know if the borrower hands them the keys to the building back and walks away, that the lender is going to just take a bath on that loan. So some lenders are allowing refinances, or they're leaving the existing debt in place and they're just letting them extend it for 2 or 3 years because they know if they don't do that, they're in big trouble. I don't think that's enough to stop what's coming, though. There's so much debt maturing in the next few years. And that in and of itself, the banks are not doing very well when they make that agreement because, say they made a loan at 5 or 6% a few years ago. If they extend and pretend right now, most banks are having to pay 5% now just to hold their deposits, right? So the banks are losing money if they allow those loans to extend. It's hitting their margins, but they're not taking that big loss on the asset of selling the building at a loss. So it's kind of, for the small bank, it's a pick your poison. Do you want to die slowly or all at once? So they may be able to slow it down in that regard, but I don't think they can stop it. The question is, can they delay it long enough for that return to Zerpenberg, for the Fed to say, okay, they've had enough, we'll lower rates again, and then you get that deluge of refis in the commercial real estate space.
I mean, we have huge headwinds, not only with the consumer, with the credit card debt, the defaults, the school loans starting in like 2 weeks. We have this whole other thing with corporate America, this whole other thing in the housing market. I mean, the fact that it's not fallen apart quicker, at first it surprised me, Jack, but when I really started take a step back, ask what happened, the bailout. I mean, seriously, man, the March bailout. I know they don't want to call it a bailout, but that's exactly what it was. They were trading toxic assets that were not performing into performing assets. And that hit all kinds of financial institutions, all the way down to new home builders. So, it is what it is. I think it's really important to pay attention. Jack, anything you want to say before we go, brother?
I would just add that what we're seeing here with loans going bad, right? With all these commercial borrowers, commercial real estate, they need to refinance their loans. With interest rates on the 10-year are rising, mortgage rates are rising, banks having to borrow expensive money, the M2 money supply contracting, the Fed's quantitative tightening. Money is getting more scarce.
Yes.
Now, that means money is getting more valuable. And what are interest rates? Interest rates are the price of money, and they're all rising. And it's hard for most people to picture this, especially in the context of the last 2 years of this massive increase in the cost of living. And we do still have, on paper, inflation is still 3%. But money is becoming a more precious resource. It's becoming more scarce. And in that kind of environment, cash is king. Because when money gets more scarce, when banks stop lending to each other and you don't get credit creation and you get a wave of defaults, when loans go bad, money is destroyed. So, people ask me all the time, what are you in? I'm still largely in cash is where I'm positioning myself, because almost any asset class that I look at right now is going to be cheaper in a couple of months or in a couple of years. So I'm still largely in cash. I've been parking some of my money in short-term U.S. Treasuries. I mean, why not? It's a free almost 5.5% to sit in a 1-month Treasury right now. I'll take it. If the government wants to bankrupt themselves, might as well do it paying me. And I'm going to eat that in the form of inflation later on, or in the form of higher taxes later on anyway. So I might as well break even on the transaction. But money getting scarce, that's something that the last time it happened in this country was 1930. It was after 29. But that was not a good time for anyone, really. But that's where it looks like we're heading right now with the shrinking money supply and the rising rates. I see money getting more scarce. I see a rising demand for money. We're even seeing it in the bond market now. We've got companies are issuing bonds at a record pace right now. Good companies with good credit ratings. They're all borrowing money at the same time, just because they think it's going to be harder to borrow next year or the year after. So there is a scramble for cash going on right now. Got to save that money, folks.
Got to save that money. Definitely appreciate you guys. Don't forget to go to Nobody Special Finance. Give Jack some love. Jack, really appreciate your time as always, brother. Definitely helpful to understand what's going on. We'll want you to do some more updates on our channel. And you guys, do me a favor, comment below. Let us know if you want Jack to come back on our channel, maybe once or twice a month, talk about GDP, the job market, or whatever it is. Comment below. We'll absolutely listen to you. And if you're out there investing in real estate, we wish you luck and we hope you win.